a studio, you're saying the future is podcasts.
Yeah.
We're actually, as a business, we're finishing off a studio upstairs, which will be dedicated to not just podcasts but filming, and it's got a proper green screen and stuff. And so we're having a bit of a look around this afternoon actually, which would be quite nice.
Well, we were thinking about what could we do, because sort of we write our quarterly letters, lots of depth and all that, but there's lots of different ways to bring in information. People have different ways of processing, don't they?
Well, there's an AI software tool that you talk to it for a while and you upload a video to it, and then you can load in a transcript and it will create a video of you delivering that transcript. It's quite clever. So if you wanted to sort of really bring your quarterly letter to life,
they can do it.
I can
do it through the software.
You can do it without actually having to sit there reading it out.
Can I do it in a different language as well?
You can.
Sure, that's possible.
Yeah, you can.
Yeah.
I think they can do 20 different languages, because I was talking to our tech analyst Ben about it the other day.
It's just wild.
Whole world.
John delivered one of his client kind of quarterly updates. It wasn't a podcast, was it? But you did it as a live webinar.
I did a webinar, yeah.
Which is a different way to.
Yeah, we do those.
Do you? Yeah, because I'm thinking. Probably think the same way as you, which is you do a very detailed note, and you do wonder how many people actually read it.
Yeah, and you just think, how can you get a sort of magnifying effect on it?
It's hard.
Yeah.
But there still remains something in the art of writing something, I think, because it's for your own sake as much as everybody else's.
It's so vital.
Yeah.
And then the question is, but you do that part of the process irrespective. Then the question is, how do I get that to as many people as I can?
Yeah.
They're kind of two different problems, aren't they?
Yeah.
I mean, we did this. Or actually, it was an ex-colleague whose idea it was. I think I explained when we were chatting, but it was to try and get some more personality out to clients, to show we're not just sitting. Not everything is just written in a very formal way. Actually try and show clients how we think and the people we talk to. So that's the main reason for it. So.
We better get talking Europe, would we?
Okay.
Good. All right. Hello, everyone. Welcome to Taking Stock After the Bell, episode 51. Short sabbatical, should we say, Husey? It's been a while. We've been pretty busy and there's lots going on. But today we're going to talk all things Europe, and delighted to be joined by Daniel Avigad. Daniel joined Lansdowne Partners, the fund management group, in April 2006 and is a portfolio manager for the European long-only strategy. Daniel has been a partner of the firm since April 2011, and he sits on the management committee. Prior to joining Lansdowne, Daniel worked for 5 years in the Pan-European Telecoms Equities Research team at Dresdner Kleinwort Wasserstein, which was ranked first in the 2005 Extel survey. So I'm sure you've got some good stories about telecoms in the dot-com period, but maybe we'll come back to that. Daniel holds a master's degree with distinction in information technology and a first-class honours in mechanical engineering with mathematics from the University of Nottingham, and Daniel is a fellow chartered financial analyst. I just want to drop that in there. In his free time, Daniel enjoys spending time with his 2 daughters and is an avid long-distance runner. Daniel, welcome and good afternoon.
Thank you very much. Pleased to be here.
Good. Well, there's lots going on in Europe, lots going on in the world. Go on, where do we start? But we thought it'd be quite a good sort of opportune moment to kind of, discuss all things Europe, European equities, and see what insights you can bring to us. We'll sort of quite like to sort of start by asking, how do you think that your kind of career upbringing, for want of a better phrase, has sort of influenced your style as a fund manager? And I'm always sort of interested in people's kind of backgrounds and how you ended up, falling into fund management or very deliberately going down that route. So do you want to give us a sort of bit of a background about how you sort of got here, if you like, your journey?
Yeah, sure. Interesting. I guess the sort of direct pragmatic answer would be the UK hasn't sort of valued engineering as a vocation for, 50, 60 years now. And it wasn't unusual for me, actually, in my sort of year of 100 engineers. I would say the vast minority of them actually went into engineering jobs, which I think is a tragedy, really.
Yep.
To me, sort of engineering and teaching are the two grossly underpriced sort of vocations that Socrates used to be David Beckham, right? That was kind of, I think should be again. But that was sort of the commercial reason as well. But basically, I find investing is, something that if you have curiosity about the world and how it works, it's the kind of role that is well suited to one's one's personality. And I like to learn about things, and I like the challenge. And I think there's an opportunity for an engineering-based approach to financial investing, because especially now, because so much of the investment world today has become, in my opinion at least, I know that sounds bad, but I don't really mean it that way. It's very sort of narrative based or qualitative
stories.
Yeah, stories. Now the human brain needs stories, but we're over exaggerating it, I think. And if one can use quantitative analysis to scope and scale, create vectors, that's I think an opportunity to take advantage or arbitrage.
Very good. And you've been running the fund at Lansdowne for how many years now? Sorry,
I guess since 2012.
And we've got a kind of few charts, I think, that we'll just sort of touch on in terms of kind of setting the scene. I mean, the first one is just a chart of various equity indices year to date. The grey line here is the European line, which is I'll move this over so you can see, is the grey line here on top is the European equity market, closely followed by the UK, and the US, I think, is the other line to note, which is the yellow line, which remains at the bottom, despite the sort of recovery from the kind of tariff lows of early April. But this, of course, is in kind of stark contrast to the last 15 years, where I think most people who've been listening to the podcast now will realise that it's definitely been a period of kind of US exceptionalism in terms of market returns. I just so happen to have picked this start point 15 years ago was when the US started outperforming, but it hasn't always been the case. But some pretty stark outperformance from the US. And actually, a lot of that has been kind of fundamentally driven. So we've got a chart here of earnings. So US earnings on an indexed basis have been much stronger in terms of the growth and the overall quantum that the market has delivered in comparison with, this is Europe, blue is pan-Europe here. So European earnings doubled in the last 15 years, whereas US earnings has quadrupled in that time. So it's been a really strong period for the US equity market, and certainly it's not been a terrible period for European equities by any stretch, but by no means the same kind of level of returns that we've seen in Europe. And just sort of one more point of this chart I just sort of knocked up, a lot of the returns in Europe so far this year, the European aerospace and defence sector looks like some sort of cryptocurrency or meme stock, as has gone pretty much parabolic. The sector itself has doubled so far this year, off the back of primarily Trump, JD Vance in Munich, the German infrastructure and defence, €1 trillion that's being thrown at it. And what are your sort of thoughts from a sort of headline perspective as to kind of where European equities are and how they're positioned, both in kind of absolute sense, but also kind of relative to the other opportunities and, notably the US? Yeah,
I mean, I think paramount to all of this is that we sort of seem to be in an age where, well, I would say the key point is that the world is heavily indebted, and in an environment of heavy indebtedness, the principal aim is not to have a recession, because then one is unable to service the debt. And I think the policy responses to avoid that recession have created elevated prices of many asset classes across the world. The first reason why Europe is performing well, I think, is a consequence of not being the most overvalued asset class. In fact, it's not. It's a low level of investment in an asset class that isn't expensive versus its history, when many are. And
we've got a chart of that here. Actually, we've got a chart of valuation of the US in yellow, Europe in grey, and UK in blue, and you can see that the European and the UK lines are very much kind of in line with their long-term. This is a 15-year chart. The US looking, relatively expensive, as it has done for a while.
And actually, despite the performance of the indices, they're still cheap, aren't they, on a relative?
Absolutely right. Yeah. So to your point, European assets do remain kind of undervalued, or at least in line with their longer-term averages.
So I think the first point is that, which is it's there's a lot of money in an asset in the US which is heavily overinvested, heavy overweight in the global index, and at high multiples versus history and other assets. And when even a little bit of that liquidity exits that big pipe into a very small alternative pipe, the rest of the world, it can have meaningful implications on the price of other assets without actually it being a lot of liquidity. So that's, I think, what's going on. And I don't think Europe has repriced dramatically enough to say that now that sort of flow is equilibrated. So we're just going through that first step really of flow-related movements in the relative price of different asset classes. The sort of profound question that follows from that, of course, is it just an overvaluation sort of being reduced in another region, or is it something else? Is Europe actually getting its act together? And I think that's something that we're not having to debate right now, but we will in the medium term, short term.
And I think got a chart here on kind of growth estimates for. I mean, economic growth doesn't necessarily drive stock market performance, but it's kind of a good, at least a sort of starting point as to what to expect growth to be. So we've got it's a slightly messy chart, but basically, U.S. economic growth for looks higher compared to Europe and the UK, both in 2024 and 2025, but also kind of looking out, and these are just economists' expectations, 26 and 27 as well. So there's a sort of an element of, Europe is fine, but it's not a bit like the UK. It's unexciting from a sort of growth standpoint. Do you sort of think about the sort of, the macro in terms of how's that going to help the companies that we're investing in, and what that means for the wider market in Europe?
I mean, I think my sense is that the overall potential growth in the economy is constrained by the ability for the supply side to expand, both in the US but especially in Europe. And that itself is a consequence, I think, primarily of the regulatory structures and policy choices that Europe has adopted primarily to preserve the status quo as opposed to sort of try to drive productivity. To the degree that the pressure is mounting, that could change, and then the supply potential could improve, and as a consequence, the growth in the economy could converge upwardly to that of the US, and that would be the next leg of the story.
Well, I think as we sit here just in financial services, for instance, and we're faced with an element of bureaucracy and regulatory burden, etc., etc. And is there any sort of sense that in Europe they're beginning to get the message that actually maybe it's a little bit too much and that we can roll some of this back, or are we sort of stuck where we are? So the risk here is that one gets overexcited at the first sign of all change. I've been investing in European equities for 25 years and perhaps have seen 3 of these cycles, so it can be longer than your career, how long you wait. That said, I would say that there are 3 forces that are interestingly, synchronizingly putting pressure on for institutional change that should be monitored, and I'll just tell you what the litmus tests I'm looking for are in a second. I mean, the 3 forces are effectively exogenous, endogenous, and the bond market. The exogenous one is Trump and the idea that China and US are separating, with Europe in the middle, needing to improve its self-sufficiency as a consequence. The second is endogenous, which is political centre in Europe is losing support and has to adopt policies that it otherwise wouldn't just to survive. And that's sort of the rise of the kind of right wing, the Maloney's reform in the UK, Le Pen.
Exactly. And the third is the bond market. I think that's the primary one actually, which is for countries that are reliant on international funding for profligate spending, that's a vulnerable, fragile position that can easily change as investors decide that the return available is not commensurate with their cost of capital.
As Liz Truss found out.
Exactly. So those 3 forces are the sort of forcing mechanism, and it's worth noting that all 3 are sort of firing a little bit in sync at the moment. So if there is going to be change, these are the types of environments you'd see it. Now the question is, will it happen, and to what extent? To me, the litmus test will revolve around regulation, and what I'd be looking for is whether I would suspect in the next 6 to 12 months we'll get an attempt by one of the European telecom operators to consolidate their market by acquiring another one. There's sort of 3 major networks in the US, 3 in China, and 3 in India each, and Europe has over 85. You can't scale and invest. You can't invest unless you have scale, and you can't scale unless you're allowed to. And the whole of the industry's competitiveness. The whole of Europe's industries are dependent on high-speed broadband infrastructure. So I suspect that will be attempted, and the reaction of the regulators to that will tell us a lot as to whether the interpretation of competition law that exists today has adapted to the realities of the world we're in or not. The other one for me would be in the banking sector, the second litmus test, which would be whether the Commerce Bank is allowed to be acquired by UniCredit.
Yeah.
There's a similar type of argument.
Story yesterday in Spain, wasn't there? BBVA taking over the bank.
Sabadell. Yeah.
Sabadell, and the regulator has stopped them from doing something, merging for a few years.
They're applying all sorts of remedies, which one can expect. The question is, are they so draconian that it's not worth doing? Mm-hmm. And that's always the way. A lot of times, what matters is the perimeter they define the market as having. Mm-hmm. So in the case of telecoms, do you include Starlink? Yeah. Do you include Amazon in your competitor universe, or don't you? And you'd have and should you think about what competition will look like in the future or just today? And your choice as a regulator is up to you as to how you define it, and the answer will be very different. So it's really about interpretation, which is ultimately politics.
And whilst we're on that point about kind of regulation, what are your sort of thoughts and views on the kind of tech sector in general? Europe have historically been a lot more anti-US big tech, and we've got the threat of the digital services tax overhanging everything. Yeah. Is that likely to continue, or will Europe at some point take a slightly more laissez-faire attitude?
Yeah, I think that's a really, really fair question. My sense is that in reality, the trade war is a tech war. The really strategic component of what Trump appears to be doing is, trying to resolve this sort of incompatibility between social capitalism, let's say, from China, and sort of market capitalism that the US has, and to the extent that Europe is inside the US perimeter. Yeah. Ultimately, you'd have to suppose that Europe will adopt closer standards to what the US are doing than they have heretofore. So I guess over time, it's going to be in the interest of Europe for technology in the West to flourish.
I guess the problem for Europe, though, is it has been a big beneficiary of sort of Chinese growth, hasn't it? And it's got to be slightly careful. It sits in the middle, really. It's been, the luxury companies have obviously benefited massively from Chinese consumption and
German industrials.
Yeah, 100%. But it's how they play that card, because that's a tricky thing to sort.
I completely agree. I think the first thing is that Europe needs to. The obvious thing is that Europe, as a consequence of this dilemma of being somewhat in the middle, is the increase in self-sufficiency where possible. Yeah. I think the second thing is to become more productive with what limited raw materials it has. Thanks for bringing up the slide.
Yeah, you sent us a really great chart actually, which is I'll sort of talk us through it. But essentially, the pies at the top show the land mass of Canada, USA, China, all about between 9,500 and 10,000 square kilometres. Sounds like a big number. Europe's land mass is effectively just over half that, 5,500. So Europe in itself is smaller in footprint, and on the bottom it's got some self-sufficiency ratios of various commodities. Europe is 35% self-sufficient in coal, 23% in oil. It's actually a little bit higher. I suppose you've got the North Sea, 15% in gas. So that 15% self-sufficiency in gas obviously came to bite pretty hard in 2022 when the Russians effectively had their gas switched off. And then likewise for the likes of zinc, copper, tungsten, iron ore, etc., where Europe has again very low self-sufficiency. So Europe is reliant on other parts of the world for natural resources in that sense.
Yeah, and I think this is the investment problem, and therefore the investment opportunity. If one takes a sort of multi-year sort of horizon as an investor in Europe, the fundamental problem is the lack of self-sufficiency in all forms of raw materials. Basically, Europe's a relatively big population in a small land area, which doesn't have very much resource. And I think actually that creates the opportunity set for us, because the solution providers to that problem are priced as if they're European, but they're actually solving quite early on some of the issues that the rest of the world is going to need to solve in time too.
Oh, I see. So we've already learned to adapt to relatively low self-sufficiency before everybody else has to.
This to me is the mature, I'd say that this is the mature expression of ESG. which is trying to be thrifty with limited amounts of resources, because the marginal return on those productivity improvements is really very meaningful.
Yeah.
And we talked about sort of the engineering background.
Yeah.
And, I would say that over the last 20 years as an investor, the opportunity set, if you were looking for growth, was based, apart from population growth or emerging markets, was basically Silicon Valley, which is sort of electronic engineering. But actually, the problems of the future require mechanical engineering and electrical engineering. And I think actually Europe houses some real talent that is globally competitive in those faculties. So Scandinavia has mechanical materials, and France, I think, has electrical engineering. The entire industry value chain is there. So actually, there's a lot of solution providers to the world's problems housed in Europe at, let's say, European multiples. That's a very interesting area for investment.
I think that's really interesting, because one of the themes that we've had in the last few years, Husey, if you sort of correct me if I'm wrong, is the idea that we're moving into a world that's a bit more physical.
Yeah.
Even the adoption of AI itself requires, a huge amount of warehouse, data centers, electricity, and then that sort of brings in energy transition, where you need copper and you need steel to make wind turbines and solar panels. And this is made out of stuff, isn't it?
Yeah.
As opposed to the last 15, 20 years where the internet sort of proliferated seemingly in the cloud.
Yeah.
And I guess it's cyclical again. Sorry, just to sort of take that one more step. If you go back pre-financial crisis, we had housing bubble in the US and steel and concrete in China when they were building out their cities through urbanization. So these things do go through sort of quite long cycles.
Yeah, that's right.
It's strange though, isn't it? Because, we talked about this actually, I think on the first episode of the podcast, which was, we felt there was a movement to this, and actually commodity prices could start to move, and there was a lot of opportunity from an investment point of view around those types of businesses. But actually the world, as investors, we know there's a shortage of these materials, but the share prices haven't really reacted, or no one's really taking note yet of what's going on. So the miners, for example, they've really struggled. Have you got a view on that?
Yeah, first of all, I'd say that actually it's not always the demand that grows as opposed to the demand for productivity or efficiency in use of those sort of scarce resources. So if you can enable less usage of a commodity to achieve the same output, that's that solution is very valuable. So it's not always that electricity. For example, electricity growth is supposed to turn from negative, which has been for every decade in the last 50, to positive, but it may not actually turn positive. It may be that the solution providers for the using it more efficiently.
Actually, that's really interesting.
And then I think the I think the second point is just that. Well, no, let's leave it there. Come on.
Well, that's sort of, if I'm wrong, one of your bigger holdings in your portfolio is Schneider Electric.
Yeah.
Which is sort of plays in exactly into that theme. It's not Anglo American or Rio Tinto that's digging stuff out of the ground, but do you want to sort of tell the listeners, Schneider, who they are, what they do, and why that sort of fits in with all of that?
Yeah, maybe I'll just link it to my second point, which is that the big sort of miners in the index, the market cap of the miners in the index is basically integrated miners. So they're sort of conglomerates, really, just sort of mining a lot of different materials. But actually, if you look at that, to me, honestly, they look like good bank, bad bank. And to access the good bank, which is probably copper and a few other sort of new age materials, lithium or something, you have to get into the coal.
You have to own the bad stuff as well.
And the iron ore. And I don't find those particularly attractive. You can find pure plays. They're quite expensive because they're pure plays. So it's not that easy to do. Yeah. We've got one, but it's a bit different. And I think the mid-cap spectrum there is probably more interesting. Schneider is a solution provider in the way I was just trying to talk about. So Schneider basically provides the electrical equipment that allows one to electrify the world. Yeah. And it does that with a... Sorry.
No, I was going to say, we'll put the chart up, Alex. I'll snip it and put it in. So we'll show the chart here.
It's quite interesting, though, from... you touched on ESG, but actually... It's quite positive that you're talking about less commodities almost being used, but just more efficiently, because I think all of us are aware that something has to be done in terms of how we're utilising fossil fuels, etc. It's an interesting point you make.
Good company though, and been a sort of larger position in the portfolio for a while.
Yeah, I think we've held Schneider now for 5-6 years, something like that. Yeah, it's part of that electrical engineering industry vertical that I talked about earlier when I referred to France. I guess the question is, why does, out of interest, one could ask oneself, why does France have that?
Oh, no.
And, to me, the answer could be, no, I don't know. If you sort of have had centuries of wars with neighbours, if at some point you think it's probably a priority to become to have cheap energy, a cheap supply of renewable energy, and I think that was the nuclear investment that France made.
The 60s and 70s, they were quite early to nuclear, weren't they?
And exactly, and it's sort of out of that has come an entire industry vertical. Now, the key question to us isn't so much whether we'll see an acceleration in demand for the product suite associated with electrification. We probably will. It's what part of that industry vertical can you find a niche where if demand increases, supply doesn't increase as quickly in response. Because then only the consumer wins, whereas shareholders, we want expanding marginal returns. This is an area we think supply can't respond very elastically to the increase in demand for various reasons.
Okay, and some obvious lessons from the UK about building some competence in some of these areas, which we appear to have lost as the Hinkley Point sort of cost spiral.
Exactly, and I think that point about finding areas where the elasticity of supply to rising demand is low, because it's hard to do, is critical. I don't know if you'll remember, but I'm sure you will, that 20 years ago or something, the German policy moved to subsidise a domestic rollout of a solar value chain. But actually what happened was that the Chinese availed of that, and every German solar cell manufacturer went bankrupt. It's absolutely critical that supply is inelastic.
Any lessons on that story for the German car industry, which seems to be battling away on all fronts?
I think that's very challenged. I really do.
Presumably you don't own nothing in the auto sector?
No, we own tyres, which is distinct. But
Michelin?
It's correct.
Yeah.
But I think the auto OEMs themselves basically have a very inflexible, large fixed cost base. That's obviously being eroded by the increased market share erosion that they're seeing both in China but also in Europe to the Chinese OEMs. And China seems to have played it quite. It's just very hard to compete. They had 200 electric vehicle manufacturers to start. That's gone down to 100. BYD's just cut prices by another 35%. Eventually there'll be a handful, but what that process of creative destruction has done is bring down the unit cost of the winner to what is it, a third of that of VW. So it's very difficult to compete against.
And then what's the sort of rationale for owning some of the tyre manufacturers?
Well, as electric vehicles increase as a share of the car fleet, the value of the tyre goes up because the battery weighs so much that the torque on the tyre is very much greater, and the imbalance of having a heavy battery at one point of the car but not spread equally also puts a lot of pressure on the tyre. So the tyre, the science or engineering of a tyre is becoming increasingly important. Now, if you have the investment sunk in the R&D required to create the compromise of materials that advantages the car, then you should be able to monetize that to a greater degree as its value over to the customer and to the OEM goes up over time. So my argument is essentially that the tyre industry should decommoditize, and that the price of a tyre should stop being the cost of its materials, i.e. rubber and whatever else, but more the value to the customer, which is increasingly important as the world moves to EVs.
Do you have any EVs? Have you experienced it? I mean, I've got one, and luckily we don't own it necessarily, so I'm not responsible for the tyres, but I have heard some, I wouldn't say horror stories, but I have heard that they do go through tyres pretty quickly. The replacement cycle, I think, does accelerate. Good. And then
I was going to say on changing the subject, but on what Germany's done in terms of fiscal deficit, etc. Do you think that's as exciting as the market appears to think it is?
Certainly in the near term, it's exciting, and I understand. I don't think Germany's going to be in a recession next year, which will be the first year in 3 or 4. So there is a momentum shift there, and they look like they're front loading it. So it can be quite aggressive. structurally, that's a different question. You could say that, what is happening is that the last country in Europe of scale that can afford to do fiscal deficit spending is now doing it, and after that, there's no one left. This investment to me doesn't look like it's entirely supply side driven. I can't honestly say that I can see the productivity improvement structurally going to emerge from this.
Okay.
If you actually include the contingent liabilities, like the additional costs that aging will have because of the pension system and healthcare, it's not entirely clear to me that an all-in analysis would tell you that Germany has the bandwidth to do this in the long run. So I'm cautious that the problem is being structurally solved through this, even though the short-term dimension is very attractive. That said, I think the problem is equally visible in other continents in the world. So it's not necessarily a problem only for Europe. It's a structural issue that the world is facing, I think.
Yeah, I mean, we've talked a little bit about demographics before and dependency ratios and what's happening in Japan, and then somewhat latterly Europe, and then probably coming for the US as well. It's a problem that society is going to have to solve.
And China is obviously in the midst of it.
China's mired in it as well, with the one-child policy sort of really kind of beginning to reap the raw impacts, if you like. So, and then any sort of stocks and sectors that you think are going to be positively impacted through the kind of German defence infrastructure spending? What have you got in the portfolio that you think will really benefit from that?
Well, I think I think the question to me is how far is Europe willing or being forced to change? And this is an evidence of something changing. The degree is the question. Regulatory reform could create a widening in the investment arena of quite a large amount. I mean, I think the biggest. So we talk about the trade war with the US, but the biggest trade barriers, the trade barriers between countries within the Eurozone are something like an order of magnitude, so 10 times greater than that between Europe and the US.
Right.
And so the potential for Europe to grow a lot more than it is, or is being priced for, is just huge.
Yeah.
So the question is really, will the regulatory environment change? And if it did, then it would have meaningful implications. I think that would come through in lots of different forms, not least, I think, a sort of financial conduct and prudence regulation, which would help the banks. You probably see an increased spending. I think we should see a redefinition of defence to be a broader definition of security. Yeah. And then that means self-sufficiency in lots of different assets.
Cyber and a lot of other sort of stuff.
It could mean telecoms, self-sufficiency. It could mean banks being more resilient, which means greater scale, which means consolidation. Yeah,
I was just listening to podcasts this morning. We were talking about it earlier. Bloomberg Odd Lots with Joe and Tracy. It was brilliant. But they had a lady who'd written a book about Huawei, Chinese telecom manufacturer, and they sort of said, back in the day, every country had their own telecoms. Marconi, for instance, Nokia, Ericsson, clearly, but each country basically had their own national champion that came out of whatever British Telecom was, or the US version, etc., etc. Now you've basically only got a handful of companies left dominated by the Chinese, and are you a serious country if you can't make your own equipment that goes into all of your communications? I don't know, and the Chinese think not, and I think that sort of
I mean, I think the extension at the extreme of that debate would be that there is at some point a greater degree of movement towards a redefinition of what the system size is, that perimeter. Is Europe at the moment is an open system with imports coming in from China is re-exporting its excess capacity into Europe. To the degree that sort of abates through interventions to even a small degree, you could see a different sort of outcome in terms of supply-demand balance for a lot of industries, heavy industry and processing industries within Europe, which are obviously very unloved. Now, it's hard to invest in that at this point, but it's worth being sort of cognizant that is a potential avenue in which the world will develop in the future.
Yeah, and I guess the Trump tariffs and this idea of reshoring, reindustrializing America, and that's sort of part of the same theme in America. And do we think the European politicians are getting the same message? And are they going to go down roughly? Again, comes back to episode 1 of the pod. Deglobalization. Okay, it's not actively rolling back, but we're no longer outsourcing more and more stuff. Where it's slowing down, if not reversing.
There was the Draghi report, wasn't there, on why Europe is essentially not growing. Do you think, I mean, that was taken pretty seriously, wasn't it? And read by majority of politicians and people in power.
Did you read it, Hughes?
Afraid not. Not yet.
The FT article about it.
I think I used ChatGPT to summarise it.
Yeah. Very good.
Yeah, that's right. It was a report actually commissioned by the EU, and I think it had some fairly sensible recommendations, actually, not all of which are impossible to sort of deliver. As I say, the one which I would pick out from that, which is really the one to see how serious we are, is they had a whole chapter on telecoms networks, which I think is the easiest thing for them to allow, because it's not actually sort of in direct competition with the Chinese. And that's where it should start. You know what's fascinating is what's going on in the UK for me, which is sometimes the frontier of where Europe is going. You know, the CMA, which is the antitrust authority in the UK, for me was a very difficult entity to deal with when we were talking about sort of supply side consolidation. I thought economically was very rational, but politically was difficult to digest. There's been a change in how the CMA are looking at things, and actually there has been a merger that has been approved in the UK telecom space. So we've gone from 4 to 3 players, which is what we're sort of suggesting might happen in the rest of Europe soon. So seeing how the UK is behaving is actually potentially interesting, because it's indicative of where Europe might be going.
And then you've got decent positions in European banks as well, so presumably there's on a sort of similar theme of reform, better returns for the banks themselves, consolidation.
Yeah, I mean, if I'm honest, we've held sort of Commerce Bank for about 20 years on this basis. So
fun.
It's been pretty hard, and then it's trebled. But you know, the idea is essentially that there's a sort of three-pillar banking system in Germany, and a consequence of the over-fragmentation has been low profitability. And as a consequence of the low profitability, they've always been involved when anything's gone wrong in terms of, you know, toxic debt in the US or the GFC. And I think the issue is, you know, that if Europe wants to be serious, it needs to be able to finance itself, which means it needs a sensible structure for its banking system. And, you know, having larger private banks in Germany seems just to make a lot of sense. And we're sort of at the point where Commerzbank is being viewed as the target to sort of catalyse that process.
My wife works for a German bank. She said the issue they have against the big US banks is the number of regional banks in Germany. To try and get proper share of savers and things like that is almost impossible. It does need a massive amount of consolidation, but that's
what are they called? Not
Sparkasse and Landesbank.
Landesbank, so I'm thinking of.
And I guess there it always seems to me to come down to incentives of the stakeholders, not just shareholders. And you know, the issue I would suggest in that sort of 3-pillar system is that you know, the lending decisions by the Sparkasse and Landesbank are not purely economic. They're sometimes based on
the good thing for the local town or whatever.
Exactly.
Yeah, and the obviously the employment rules are pretty onerous. It takes a long time to change things, and I guess to make cuts where cuts need to be played. You know, employment law is very strong, isn't it? So,
that's right. That's right.
And then the other sort of big sector in Europe, and one area it's well known for, is luxury, LVMH, Richemont, etc., etc. There's sort of thoughts on that?
I mean, I've not done very well with them over the last 20 years, I must admit.
Good honesty, I like that.
The reason, I'm going to concede that this era, there's many things I've learned, and I'd like to improve on this one. I'm not sure how I could have done it so differently given our investment approach, which is essentially capital cycle driven. And one of the things we always look for on a sort of demand driven story is anchors to underpin the sustainability of it. And where I've always found it hard, but it may be my character as opposed to it being hard for someone else, is to sort of really buy into the idea that this brand is always going to be the hot brand for those seeking luxury. And I've just struggled with this idea that one company through time can always be, you know, sort of where the market is going, and therefore haven't really been able to capitalise on it.
Yeah, I mean, I guess LVMH should be the kind of the poster child for the sector, and it's probably, you know, Louis Vuitton as a brand is probably the one that has been constant. But I mean, Gucci have got problems at the moment. In the UK, we've got Burberry, and that's kind of been in and out of fashion over the years. Well,
it's not even clear. I mean, there is a question, I think, still whether LVMH is, going through a sort of renewal phase with a change in the old guard to the new guard.
Yeah.
How much it's been how much price it's taken, and then is it now saturated in terms of, if I talk to my daughter, which I try to, about these sort of things, it's not the thing that she would come up with as what she most wants to own when she goes to school.
No, that's interesting.
Yeah.
Yeah, well, the stocks haven't done particularly well, have they, in the last, since the sort of end of the pandemic, I guess. I mean, LVMH has halved since 2023, so it's been tough, and yeah, they pushed a lot of pricing in the sort of pandemic. We were all sat at home.
Certainly did.
And spare money to spend. It's been a kind of difficult area. Any other sort of sectors or sort of stocks that you wanted to mention that you think sort of interesting to the kind of whole European backdrop?
I mean, I would say that as a theme, I would say outsourcing. So here I would say that for two reasons. One is, in times of increased economic volatility and lower visibility, most companies in most industries want to reduce the asset intensity of their own balance sheets and variabilize their cost bases. And if they can find suppliers of non-core things at their activities, they'll go for that.
We've seen what's happened by the likes of sort of Compass Group, catering and things like that. It's been an absolute winner since.
So I think there's lots of categories. Exactly. Compass is a very good, in my opinion, example of an outsourcer that's benefiting from an acceleration in their TAM. Their addressable market because of this.
And actually they're targeting Europe a bit more, aren't they? Because I think it's been quite difficult to break into it, but they've got a big focus on winning market share in Europe.
Yeah, exactly.
I get a bit sort of tired by outsourcing. I mean, yesterday, for example, I was organising milk for my children at school in September, and it's outsourced. I'm like, why does a school have to outsource its milk provision to its 5-year-olds? I mean, honestly, can't someone just organise this? I have to go, and then money's being changed. Anyway, I get the point that we want to simplify their operations and reduce capital employed in their balance sheet, and as you say, turn kind of fixed costs into variable costs. But
do you own anything else? Do you own anything else in the portfolio that's
a beneficiary of outsourcing? Yeah, I mean, I guess. There's different ways to define outsourcing. I would say insurance is one example. So we have Sampo. But there's others which we have in the past or would again. Construction equipment rental, pest control services, those sort of things. We also keep an eye out for. I think are interesting.
Good old Rent-A-Kill.
Yeah.
Again, I mean, that's really. I like the sort of the three pillars kind of principle of what's happening in Europe and how that's kind of moving along. I think there is definitely some legs in there, and the politics ultimately. And the problem with European politics, and I guess part of the reason why many Brits decided to vote to leave the EU is that it's not brilliantly dynamic and organisation that's good for change in that sense, and it tends to be very slow. And you're absolutely right, the UK tends to be at the vanguard, and then the US goes first, the UK sort of blithely follows, and then Europe eventually get their act together, and they sort of get there once all other options have been exhausted, so to speak. So I think there is change happening, and I think the regulatory stuff's really interesting, and the German kind of fiscal stuff and the defence is all kind of part of that, isn't it?
I think the sort of the question I'm grappling with, I don't have an answer, but this sort of population, let's call it the demographic problem. The demographic problem being that, as you I think alluded to earlier, the working age population is shrinking and the dependent proportion of the population is rising. At a point in time when there's already too much debt in the world. And I think AI is potentially the solution here, though. The law of big numbers means that productivity is shrinking as we go, and unemployment is very low, and sort of migration is slowing. So we really need something to boost productivity. Otherwise, supply growth potential in the economy is shrinking. If it's not that, then somehow we need more people. And the question is if that's not immigration, which politically doesn't seem to be something that the population in any country is really considering as attractive, then how do you get sort of domestic population growth? What policies engineer that?
Is it the Swedes or the Danes spending? I mean, there's some sort of incentive for families to have a third child, and it's, meaningfully high.
Yeah.
Thousands of euros or something, one of the countries, but to that point, replacement ratios, very simplistic terms, not very high, are they?
Italy's had things in place for years, hasn't it, to try and encourage population growth, because I think their population growth is almost, I think it's one of, if not the lowest in Europe.
I think that's right.
But it's difficult to encourage it.
I mean, I was just listening to a podcast with Orban.
Yeah.
And I mean, Hungary have now, they say basically, essentially, if a woman wants to come back into the workplace after working, then they are not taxed for the rest of their life on their labour. Yeah.
Wow.
Yeah. Which is more extreme than we've seen anywhere else.
Yeah.
But actually, I need to check the data.
Yeah.
What he said was that they've seen better population dynamics up than the rest of Europe up till COVID.
Right.
Subsequently, it's been slipping back again. So it really is an issue.
I mean, you've almost answered the question you sort of asked yourself in terms of how do we get more productivity. It is encouraging women back to work. It's part of the solution,
absolutely.
Isn't it?
100%.
Because I know, around this table, us four, we've all got children. It's a difficult thing to juggle when my wife works full time, and trying to have kids in the right place at the right time, let alone me being in the right place at the right time, is quite complicated. So yeah, it's something that needs to be addressed.
But I'm going to sound really old now, but I mean, and sort of old manny. But I think I apologise, but I think probably the sort of it's going to have to start with a better education system, and this sort of emphasis, I suppose, on STEM subjects. I saw that the US is producing, I think it's something like 150,000 STEM graduates a year, and the number in the US, I think, is 10 times that.
Wow.
So it's going to be very difficult to compete on that sort of basis. And I guess the question for us is sort of how do we change not only what is being taught, but the mindset about self-responsibility as well.
Yeah.
Well, that sort of brings us back around to where we started, really, isn't it? Engineering and science and maths and things. So there we go, listeners. Go and do some engineering in university. Don't do finance. Should we call it a day? Is there anything else from you that you wanted to?
Nothing more on that.
No, Daniel, thank you so much for coming along. That was really interesting and really insightful. Some good stuff to think about, and we'll see what the politicians get up to and the regulators and the reform, and see if we can make some more progress. Thank you all for listening and watching today. Any questions, then get in touch. James.Hughes@Quarterchevia, or I'm Jonathan.Raymond@Quarterchevia.com. And we hope to see you next time. Thanks very much. Bye-bye.